All right, we are live on the one screen. I'll make sure we're live on the other.
Hello, everyone.
But it's so great to be here.
Yes, Maggie is connecting us to the outer limits. She normally is with all of her technology, but we're glad to be here in our purse strings group. You need to change the bottom, Maggie.
Oh, I thought I did.
Yeah.
Oh, it didn't save. All right, let me change this up. You guys keep chit-chatting.
Yeah, Matt. So guess what, Matt? I bought a house.
You did?
Mm-hmm.
That's awesome.
Yeah. So moving at the end of June.
Well, that is just being able to buy a house right now is a feat of just, it feels like luck with how crazy the market is.
Oh, yeah, definitely.
Winning the bid is
yeah.
tough.
Well, we had our strategy in place, so up early, out there first, had all of our ducks in a row, had pre-approval, and yeah, we were good to go.
That's awesome.
Yeah, it's great. So, yeah, how are we doing, Max?
Good, we're getting there.
Okay, so well, I'd like to at least share the purse strings mission, which is that we provide women free online tools and resources to make smart financial decisions for themselves and for their families. And not only that, but we also promote top-tier financial professionals to present their expertise. And so we have Matt today who's going to talk about home buying questions. So anything from a lending perspective. And as Maggie said, I don't know if you saw the live, the Insta this morning, Matt, but Maggie was singing your praises and talking about how you always talk about how it's important for women to buy houses as well.
Absolutely.
And what that means in terms of their legacy. So yeah, so check the information down below, Matt. Make sure we have Primary Residential Mortgage, Inc. and your contact information being presented.
Mm-hmm. Perfect.
Good. Good.
All right, we'll wait for a couple more people to jump on and then jump in. And Matt, where are you coming from today?
Yeah.
So our home office is outside of Cleveland, Ohio, in a little town called Worcester. So in the Midwest, we have a few other offices throughout Ohio, but our main hub for our national business is here in Worcester.
Got it.
That's a fun name. It's a really fun name.
Yeah.
Fantasy kind of thing. Last few days, but I sound 10 times better than I did last week. But
are you fighting something?
Not really. I just got the congestion. I know you guys are outside of like Chicago, and Maggie, where are you at? You're not in Chicago.
I'm in Cincinnati right now.
I was gonna say we're in like rural farm country where I live, and boy, the pollen and stuff like that that when the farms do their first like kind of chopping of the season, allergies just explode. And so a lot of my kids have it worse than me, my wife does, but this time for some reason I really got it and just clogged me up for a couple days.
Yeah, I know everyone's been hit really hard with allergies this year. I don't know what's blooming, but so
I just think we didn't go outside last year, so our body
it could be true.
Our bodies got used to this, like, wait a minute, this recycled air is pretty easy to get through, and then you go outside and there's pollen and all this other crazy stuff. So ragweed.
Yeah.
All right. Well, I'll give a little intro to Matt, and then I'll give you the floor.
Great.
So Matthew has been working in the mortgage industry since 2007, beginning as a loan officer assistant. He has worked his way up to division manager with Primary Residential Mortgage, where his main role is to travel and educate referral partners on strategic equity management techniques. Matthew completed his bachelor's at Liberty University before joining the mortgage industry. And so that is great. We'll give you the floor, Matt. Thanks for being here.
Great. And I so greatly appreciate this opportunity to share with everyone, Maggie and Dr. Provost. It's important for myself, our company, our our mission statement, besides actually transactional mortgage activities, which is writing and closing mortgages, is education. It's a really big part of what I am focused on doing, whether it is a referral partner like Maggie just talked about, financial advisor or a state attorney, or it's direct to the consumer like we're doing today. I have found over the years that the home buying process, home ownership as a whole, a lot of times isn't really taught as a skill or something to manage over your lifetime. You kind of go to a bank, they say you can borrow this much, you go look at a house that fits that, you get it, and then from then on, you're kind of on your own figuring out what you should do, how you should plan, and especially when we're talking about minorities and especially women and women of color, the percentages, if you actually look at it nationwide, are so much lower in home ownership in those areas. It's been a mission of ours over the last few years to really go and seek relationships in those areas like purse strings, so that we can maybe provide some education, uncover some things that have maybe been left out of the education process, so that people can understand how they can become homeowners, why it's important to be a homeowner, and start to really build that equity, build that wealth, build that legacy through their home ownership. So that's my goal today. I'm going to be pretty succinct. I'm not going to take up too much time, but I want to get through a few things and some stats and just some best practices for today. Of course, the home buying process, to dwindle that down to a 30-minute or 25-minute conversation, is really tough. So we're going to hit some major points, talk about some things that I think most people are running into. So when we talk about find your home and change your life, we really believe that home ownership not only is, a pillar of, we'll call the American dream or whatever you want to call that, but really when we talk about building wealth, legacy, and generational wealth, and we'll show you some stats behind that. A little overview today. We've just got 3 small topics. We're going to talk rent versus buy. We're going to talk about the down payment and the programs that are available. And this is really where I want to drill into a lot of things. And the last thing we'll probably spend the most time is in the credit conversation, because I feel like of all the things in the home buying process, credit scores, what goes into them, a lot of times is misunderstood, seems like it's nonsensical, and people get so frustrated with it, they just go, I don't know. I don't get credit. I'm not going to really try to fix my credit because it doesn't make any sense. And they don't know that sometimes a few small foundational things to try to achieve can greatly improve your score. And I'm talking hundreds of points over a 6 to 12 month period. So those are the 3 main parts we're going to talk about today. Is when we talk about rent versus buy, understanding the cost of home ownership is imperative in figuring out your buying power. The cost of homes, and we see this right now, home prices are going up, and they have been for about 4 years, but the last about 18 months, they've gone up at an exponential rate. And so people are looking at it and going, is home buying too expensive now? Is it better to rent? The problem is rents are going up at an even higher percentage. And when you look at a place like we see here, a rent of $1,500 a month, which is in many areas not a high-end rental. It's maybe a 2, maybe a 3-bedroom, smaller place. It's not really, your luxury rental. That is the equivalent to about $275,000 to $300,000 mortgage loan. And when you see how expensive renting is compared to buying, you see the value in purchasing and owning your own home is even greater. Just for food for thought, every $100,000 that you finance over 30 years is generally about $500 a month. And that's right now where rates are, it's a little bit less. It's about $480 a month, but we use that 500 round figure to show about how much things will cost to buy. And so if you're paying $1,800 a month right now in rent, you could buy a home for $300, $325 right now and have the same exact mortgage payment. But instead of just having that rent go out the door and not having any equity built in, you'd start establishing equity. And, we see this housing market continue to grow. in 4 and 5 years, you could have an equity space that's really great, and there's some value in that. When we talk about generational wealth starting in the home, the Federal Reserve reports that the median wealth of homeowners is $255,000. That's nationwide, compared to $6,300 in non-homeowners. What that means is that people who don't own homes, on average, per capita, are more transient, have less invested into their community, and feel less a part of their community. There's a lot of other figures that go in with this. Non-homeowners are 5 times less likely to vote in local municipal voting, like school levies and local representation, things of that nature. They don't feel part of their community, and they don't end up voting. And when we're talking about all of these issues we're seeing right now nationwide, as far as just evolving our communities, we need to be putting the people in office locally and nationally that are pushing the right initiatives. Homeowners generally do more voting, so we want to get people into homes because then they feel more roots in their community. They want to be affecting of change and be part of that. And building home equity translates to wealth, not just present, but future generations. I look at where we live in Ohio, and I live in a really rural area, very middle class, not upper middle class, very middle class. But over the last 3.5 years, we've seen home values raise almost 40%, which means that if you bought a house 4 years ago for $100,000, it's worth probably well over $140,000. That's value, that's wealth, that's home equity that has just appeared while you're paying down your mortgage in those 3.5 years. You're creating this gap in home equity where, maybe that's the pool of money you draw from to buy your next home, where you buy a bigger home in a school district that maybe fits your family's needs better. Or, you hold on to that house for the rest of your days. And when you pass on, your children have a house that's paid off that's worth a few $100,000 that helps them build their legacy on past that. So it's a foundational aspect of this generational wealth we talk about with home ownership. And so how do we get to buying a home? That is a really, that's the question of the hour. A lot of people will say, I'd love to buy a house. I don't have 20% down. If I want to buy a $200,000 house, 20% down is, $40,000. I don't have that. And the truth of the matter is, over the last pretty much 20 years, 25 years, the products have really expanded in the home buying process, especially for first-time home buyers, especially for middle-income people. There's a lot of different programs. We have, just to name a few, we have a couple like USDA, which is if you live in a rural area, you can purchase a home for 0% down. If you're a veteran of the armed services, 0% down. If you're a first-time home buyer with good credit, you can do a conventional loan with 3% down. FHA is 3.5% down. FHA is generally for people with more middling credit in the mid 600s, but 3.5% down. Many states, especially I can tell you in Ohio and I know Illinois and other states throughout the Midwest and nationally, have what we call down payment assistance programs. And those are grant-based programs that are refilled every year. And what they do is, let's say your minimum payment is 3% down. Your state may actually be able to give you a down payment assistance loan for 2% that's free of charge, that as long as you stay in that house for 5 or 7 years, that 2% down payment that they gave you just actually disappears. And so you only end up having to bring 1% of the purchase price down, and you get 3% equity. And so you're basically getting free partial down payment on your home. And on all these loans, closing costs can be financed depending on how you work your contract with who you're buying your home off of. And so when many people will initially think like, oh, I've heard that you got to put 20% down. It'll take me forever to save that. I'm never going to worry about it. But for a lot of people, with the money you receive in your tax return to buy your first home, you a lot of times can purchase a home with that, or your tax return plus a little bit of strategic savings. You can have the money down for a down payment very quickly. And getting yourself off that hamster wheel of rent, which is just throwing money, I don't want to say away, but throwing money to a place that does not return to you any value other than the roof over your head. And so there's a lot of options in these down payment programs, these different loans, and really what I would advocate for you all to do is try to find a mortgage loan officer, lender that will advocate for you, that will be educational, that will take your call and help you understand where you are at, where you need to be, and help you plan for that. Because that's the thing that's frustrating about my industry. A lot of times it's so transactional. People just say, hey, you don't qualify. See you later. Let me know when you qualify. Instead of helping people who are a little bit off, give them a game plan, say, hey, you know what? You need to have $6,000 saved. So the moment you can get the $6,000 saved, call me back. We'll work on getting you pre-qualified and going from there. But the down payment is something that's very flexible between products. And especially if you're a first-time home buyer, there's a lot of options that are low to no down payments. Excuse me. And so let's have the credit score conversation next, really. And this is, and I completely understand, this is a lot of times the most common frustration we get with clients. Just because credit scores definitely seem nonsensical, the number, what goes into it, seemingly things that you would do that would raise your credit score, lower your credit score. Like, I bought a car and they told me my credit score was 800. And then the next month I get my monitoring, my credit score went down 20 points. That doesn't make sense. They just get me buy a car. Why would my score go down? So there's all these things about credit scores that are seemingly mysterious. And if you've ever had an issue with your credit or issues, maybe there's a bankruptcy, you go through a divorce, and there's many times just collateral damage, we call that, through a divorce or a loss of a business. And so credit becomes part of that collateral damage. And people will say, you know what, in 2012, I lost my business because of the economic crisis and I have bad credit, and it's 2021 and they're still walking around saying, I have bad credit. And they haven't pulled their credit since, or they haven't even looked into it. So we see a lot of people just reside to the fact that they made one mistake and that means that their credit's bad forever. And that's really not the case. Your credit score, your credit profile is a living, breathing thing. And for many people, as long as you're just right, not just right out of a foreclosure or just right out of a bankruptcy, a lot of times your credit score can be elevated, can be bumped up a good amount by just helping you understand a few different things and putting a plan together to accomplish that goal. One of the things we hear a lot about too with credit scores is, I have my Discover card or my Chase or my Capital One, and they give me this, free credit report every month or free credit score. And they said my credit score was this, and then I called Matt, and my credit score is 20 points lower. How is that? Why is my score with Capital One different than my score was with you? And like I said on the screen, there are different algorithms for credit scoring. So a car dealership to buy a car is going to have a different algorithm than a credit card is going to have a different algorithm than a mortgage. If you think about it, your credit score is going to be a lot higher with a credit card than with a house, just because you're asking to borrow a lot less. So the more you're going to ask to borrow, the more stringent the algorithm becomes on your borrowing history. And so that's why a lot of times we see people with higher credit scores on their, Cap One account or their Discover account, and they come in here and it's lower. So there are different algorithms. And with the mortgage, a lot of times those credit apps are only pulling one score. We do pull all three. And what we do is we throw out the top and we throw out the bottom. We take the middle score. And so we're going to take the middle of all three. Generally, all your credit scores are within a pretty tight range, 10 or 15 points, 20 points maybe. Very rarely do we have somebody with like a 650 and an 800. That means there's usually a reporting issue in there. And so now we understand credit scores are a little bit different depending on the platform we're using. And the mortgage credit pull is all three bureaus. One of the people will say, well, why is my credit score bad? Other than, maybe the obvious, I missed some payments, or, I had a rough period where, I missed some mortgage payments, or, I had a car impounded, whatever. After that, how do I get my credit back to a healthy place? And so to understand that, we have to understand what goes into your credit score. So this little cool little diagram shows of the 100% of your credit score, what percentage each thing has in your score. So the biggest thing, of course, is your payment history. So your score is a example of your ability to repay your past debts. So how many times have you been late? How frequent is it? Have you had a couple over 10 years that were random? Or does it seem like every year you're missing some payments? The more random or they are, or the less apparent any lates are, the higher your score is going to be. If you continually miss like a credit card payment here and then get caught up, and miss a car payment here and get caught up, your credit score is going to stay low because it looks like you're not really budgeting correctly. Your score is going to stay low. The next biggest one is amount owed, and this is really important. This is the biggest thing that you can do. This biggest area that you can correct your score and get it elevated. One of the things that credits looks for is, it's not that they want your credit cards paid off, your credit accounts paid off. They want them under about 35% exposure. So if you have $1,000 limit, they want your balance under about $350. And so what happens, we see with some people is they'll have $25,000 in credit card debt, and they'll get a bonus from work. And what they'll do is they'll pay one credit card off that's $11,000. And they go, that's the best thing, but they still have two other credit cards that are maxed out. And really the best thing for your credit score is actually trying to lower all of your balances under that 35 to 40% threshold. And that will raise your credit score a lot quicker than just kind of knocking off one credit account at a time. And so that's something that we can help you with as your partner. If you were ever to want to utilize our services for a mortgage, we can help you. We have what's called a credit what if scenario machine. It's something where I can look at your credit score and say, hey, if we had $3,000 to spend, we could spend it in these three ways, and it would raise our credit score, 19 points or 25 points. But the amount owed is very important. So maxed out credit cards that are rolling maxed out or close to it month over month slowly start to deteriorate your score. 10% is your new credit. So generally speaking, on a credit report, new credit is bad credit because they don't have any history. So anytime you buy a car or open a new credit card, your credit score always goes down a little bit initially because it is a new account. And that's why the next thing, that 15% length of credit history, one of the things that I'm very big proponent of is not doing the whole flipping credit cards for the 0% 12-month APR thing. We see a lot of people do that. And while financially it may make a little sense because you're not paying interest, you can pay your balance down, flipping credit cards, opening new accounts, and rolling balances over to new cards every 12 months will hurt your credit because it is not, you're not showing any longevity in these credit accounts. And so we want to, the best thing you could ever do is open a credit card when you're 18, 19, 20 and never close it. Even if it's not that great of a points card or, doesn't have the benefits of your new cards, keeping it open, maybe using it once or twice a year to fill your gas tank up and paying it off. The longer that credit card is in your name and active, at a certain point, it just is earning you points and you're raising your score arbitrarily all the time. Excuse me. And the last thing is credit mix. What they mean by that is the difference between installment loans, which are car loans, student loans, personal loans, revolving credit, which is your credit cards, things that you can add to lower, and then mortgages or lines of credit, which are liens against a home or a business that you're paying off. You want to make sure when we talk about credit mix, the one thing that I always tell people, if you're taking notes on this, to try to avoid is department store credit cards. Even though that Kohl's card promises you 35% off if you sign up today, a couple things about those cards. A, their interest rates are ridiculous, 25, 28, 30% sometimes. The other thing is those are generally hard money credit cards. They're not backed by Visa or MasterCard. They're backed by a hard money lender. So what that means is if you miss one payment, they'll send you to collections a lot of times. And so people, and they don't have as robust of a servicing end for customer service. So if you do have an issue, a lot of times you're really struggling to get it resolved. We see people all the time have perfect credit, but they have a Kohl's card or a Victoria's Secret card or a Macy's card, any of those kind of cards, and they miss one payment because they just didn't mail them a statement. They wrote their number down wrong or their address down wrong, and their credit is really hampered by 100, 150 points from high 700s to low 600s because this department store credit card, the only reason they signed up for was because when they bought a TV, they got an extra 20% off or something, has ruined their credit for like years. So stay away from those department store credit cards as much as you can. Really, as far as good fundamentals, you want to have like an everyday spending credit card. That's your point, quote unquote, points card, one that you get good points. You'd want like a longevity credit card with a high balance. So, one that you never really use, but has a high limit in case you need something that you can't pay with your savings account as a side one. But that's really it. You don't really need more than 2 credit cards. Nowadays, there's a lot of different point systems and mile systems. You can all really get it encompassed in one credit card. But having the one main and one auxiliary card with a high balance is really all that you'd need. And then you'd have your installment, maybe car or student loan stuff. But making sure that you don't have 10, 20, 30 accounts open at once, that will also hurt your credit because your exposure is really high. So we talked about this a little bit. How can I improve my scores? Credit balance is under 30%. That is like the credit bureau's official word. We actually see improvement in score if you get it under 50%. Under 30% improves it greatly. Like I said, keep older credit accounts active. Don't just cancel cards. Don't flip those cards into those intro rate cards. You can't miss payments. Your ability to repay and your history is very important. And like we say, avoid same as cash credit accounts. Those department stores, those jewelry, the furniture, all those things that give you a year to pay things off. Those are minefields for your credit score. If you make a mistake on them, they can be very, very detrimental to your credit history or credit score, credit future. But getting all those things in line, like I said, partnering with somebody in the mortgage industry to help you, assess where you're at. A lot of people just think they have bad credit. Sometimes it's just calling myself or a loan officer that if you're looking to buy a house, you don't have to have a house picked out. If it's just having the desire to own a home, that's when you want to start talking to a loan officer that you trust, because we can pull your credit, see where you're at, see where you need to be. Maybe you are actually in a place already where you can buy, or we can put together a plan that says, it's May. If we keep our nose clean and save like we need to, let's talk on Halloween. The week after Halloween, we should have the money saved. Your credit score should be even a little improved. Let's do the other pre-qualification then. And we can really chart a pathway to home ownership, because that is really the key to really, like I say, like growing roots, not only in your community, but growing roots in your family tree, so that there's equity being built, not just monetarily, but, in your community with being a homeowner and being a part of where you live. And Maggie, I hope I didn't go too long or too short. I kind of wanted to keep it, at the high level here.
That was great.
Yeah.
It was great. And I feel like there was a lot of really good takeaways that are actionable steps that people can take after this to kind of know and prepare for buying a house. I'd love anybody watching to comment in any questions that they may have. There were a couple things I wanted to bring back up, which I thought were really interesting. One was how, when you buy it, how it affects where you do vote and political and things like that. These things have such exponential, it's like, it's not just buying a house, it's generations, it's voting, it's helping the community. So it's a lot more than just, a house, even though a house is a lot, which was a really interesting point.
Absolutely. And that's, especially, we look at, I love looking at demographics and seeing where, like, not just my industry is going, but different areas. And we see in not just in financial services. So overall, over the last 30 years, a financial advisor was an old white guy. Let's just be honest. A mortgage person or a banker was an old white guy. Let's just be honest. And we're seeing now where it was like 1 out of every 10 finance graduates was a woman. Now it's 6 out of 10. There's actually 2 out of 10 are women of color. And so those demographics are changing, and not just in financial services, but in the professional and the financial world. And understanding that the next generation of home buyers a lot of times is indicative of who's graduating with what type of degree. And we're going to be seeing a lot more of families of color, families of different language. Like that's another thing too. Like we have a loan officer here that's bilingual, that speaks Spanish and Portuguese, not because Worcester, Ohio has this enclave of Hispanic families, but other areas of the country have that. And you're just seeing all these emerging markets where it is really gross when you look at gross is the bad word. And I'm not trying to hate on, look, I'm a white guy, whatever. But it is, you see the percentage of home ownership is, so high in Caucasian communities, which is great. It doesn't mean that those people need to stop owning homes. That's not what I'm saying. But we need to have direct initiatives for women and women of color. And I'm really passionate about women of color to have opportunity, to have education, because that is literally the first step in their 2 generations from now. That first home purchase is going to be affected by that. So, not to get on a soapbox or anything like that, but that's why I want to educate. This is not like, hey, my interest rates are low and I'll close your loan real super fast. And
right.
It's not about that. It's about educating, because even if you use somebody else, whoever's listening to this, please do buy a home if it fits your financial budget, because the long-term ramifications of it are great. Not just in your personal wealth, but like we said, voting, just community enrichment, who you are being seen in your local area. When you're a homeowner, you're more apt to do that, more apt to be involved. And that's what I love about it, is home ownership is a community-based thing. Your neighbors are involved in everything else. So I'll get off my soapbox now. I apologize. But it's a really big thing for us, and very important for us to spend our time educating that set of people coming into the market.
Yeah, it's something I don't think a lot of people think about or know a lot about. It's more just always focused on the money. And now it doesn't have to be such a barrier. I mean, 3% on it could be, $6,000. It's not terrible.
Yeah.
And I know you said that some of the closing costs can be wrapped up in a loan. How much is a typical closing cost, or is there a percentage there that people use, or what's a ballpark?
So, yeah, that's a great question. So the thing about closing costs is every state is different.
Classic.
Yes, absolutely. Welcome to the siloed world of lending. And so generally speaking, $3,000 to $6,000 in any state is going to get you your cost. Some states put some of the fees on the seller. Like Ohio is actually one of the better states, I think. When you're buying a house, about 30% to 35% of the cost for like transfer taxes and escrow aggregation is actually on the seller side of the table. So you get a little bit of a break. On other states, Pennsylvania, it all is on the buyer. And so their costs are just up because they don't, the seller isn't participating in that side of things. But there's something called seller concessions. And it's a very normal thing. Most of our loans have them. And what they are is, you can say you're going to buy a house for $100,000. You could then go to the seller and say, I'm going to offer $105,000. And I'm going to ask for $5,000 in seller concessions, and that's going to go towards offsetting my closing costs. Now, to the seller, they're still walking away with $100,000. They're still netting the same amount, but that's a way for somebody to borrow their closing costs, so it mitigates that out of pocket other than the down payment. Now, you can't borrow your down payment. You can receive a gift as a down payment. So if you have and it's got to be a direct family member, so brother, sister, mother, grandmother, father, grandfather. If they say, hey, you know what, I'd like to give you $10,000, or you know what, here's a little advance on your inheritance, here's $10,000. You can have a gift be part of stand for your down payment also. So different programs have different things, and that's why you would work with a loan officer. But there are a lot of ways to shape a loan where, the buyer has a minimal out of pocket. And sometimes that's the goal. Sometimes somebody says, hey, man, I got $100,000 to put down. Great, we'll do that. But if cash on hand is the struggle, let's try to repurpose your loan scenario to fit, your finances. Or say, hey, you just need to, you need to buckle down and save an extra $4,000. And once you get to that extra $4,000 mark, let's get in the housing market. just have a
Awesome.
plan for it.
Yeah, that's great. That's great. Let me see if Dr. Barb has any more questions for today.
Hi, Matt. Thanks so much for that great info. I do have one question about credit scores. So what if you're buying a house with a partner and your credit scores, one's good, one's not so good?
Yeah.
Which one do you look at?
So if great question. We follow the money. So whatever the income that I'm using, so that's the thing that stinks sometimes is the person with great credit doesn't work and the person with bad credit makes all the money. We have to use whoever's qualifying for the loan as far as the income side of things, we have to use theirs. So if we're using both spouses' incomes, I have to use both their credit scores. Now, sometimes we'll have like a spouse that works and one that doesn't, and we won't even pull the other spouse's credit. We'll put them on title, but not on the financing so that they don't bog down the qualifying or the credit score. But I have to use whatever credit I'm using. If I'm using income, their credit score goes on it. Is the easiest way
Got
to
it.
do it.
Okay, good
Makes
to know.
sense.
Yeah. Well, this is great. And, the home buying market is crazy these days. So
Absolutely.
in a good way, I guess, right? Since you want everyone to buy a home. And that's kind of what the pandemic has said to us, get closer to family, buy a home, get your roots in your community. So
Yep.
this has been great information. I took a lot of copious notes while you were speaking. So we'll have a handout for everyone to take a look at as well.
And please feel free to email me. That's my office number below. I have a team of loan officers, staff that would love to help you, even if it's like I've never thought about buying a house till I heard you talk, Matt. Where do I start? Or I've been trying to buy a house for 2 years and nobody will give me the right answer. We have done things. We have these success stories where 3 years down the road, they buy a house because they were in a really bad place when they met us, and we gave them a plan, and it took a while. Some people just don't have the wherewithal to save a lot of money.
Right.
You know what I mean? There's bills, and so, but there is a path to home ownership always. Sometimes it's right now, sometimes it's in 6 months, sometimes it's in a couple years.
Yeah.
And we can help you find that path if you're looking for it.
Awesome.
Sounds great. Yeah, that's awesome. Thanks, Matt.
Well, thank you, Matt, for coming on today. You can always reach Matt at Primary Residential Mortgage or Shanlian at premiers.com.
Prime Res, yeah, I hate the end of that thing. PrimeRes.com.
Yeah, what he said. He's also one of our Purse Strings approved providers, so you can check him out on our Purse Strings website, pursestrings.co, and reach out if you have any more questions. We'll be back again here next week. But thank you, Matthew. Talk to you soon.
Thanks,
Bye.
Matt.